Hi everyone, a very good evening and welcome once again to yet another Edelweiss Connect classroom session. I'm sure one of the questions which may have popped up in all of our minds at some point in time or the other is, am I doing enough in terms of investment that if there is a requirement in the future, a financial requirement in the future, I would have sufficiently created the money for that requirement and being and I would be able to fulfill that requirement without a lot of stress, because whenever we invest, we think that we will use this money at some point in time in the future, right? So I'm sure that question, it's come in my mind, it's come in a lot of people, a lot of people whom I've spoken to mind, and I'm pretty sure that it's come in every one of us mind. That am I doing enough? Will I be able to, generate enough capital or wealth to manage my future financial requirements? And to do this, many of us would have perhaps spoken to people for advice, Googled, or even discussed with friends and families that is there a template which I can follow, which will give me some idea of what I should be doing in terms of my investment, right? While I can tell you that there is no one template which can fit all, because investments is actually a very, very personalized, customized, a very bespoke kind of a thing. Wherein what your future requirements are, what your time horizon is, what your risk appetite is. A lot of these permutations, combinations, and questions need to be answered before you actually come down to what your investments should look like. But what I'm trying to do, or what I rather aim to do through this program, is give you a very, very basic design and a generic idea as to what your investments would follow, basis at what stage of life are you on, and are able to do, get some idea as to what you could be doing. Like I said, by no means this is a template which you should blindly follow, but this could be used as a guiding principle, as a starting point, as a checkpoint, to check whether your investments are in sync as to what perhaps could be an alternate option if you're not following it. So that's going to be my agenda and my idea. As usual, I would request you to put your questions in the chat window, and I will respond to each and every one of your queries and questions towards the end of our session. So on that note, let's begin, and let's first understand what life stage investing is. You know, uh, so what I'm going to do through this program is I'm going to help you ascertain the different stages that we all go through during the course of our lives, right? And hence, what we also need to be doing is we need to be very, very conscious of these stages, and through this consciousness, become better financially prepared for this life stage. Being better financially prepared for these life stages would obviously mean that I am able to manage these life stages with a lot less stress, and able to use my investments optimally for those requirements which will come to me at that stage. Being better off financially obviously will also help me to tide through these life stages by being far more comfortable and leisurely, rather than being very, very stressed that am I doing enough? Will I be able to do this properly? Will I be able to have the money? And somewhere these questions will not bother you as much, because somewhere you have thought about this earlier, and basis this have had some kind of a preparation. So that's what life stage investing is all about. If you talk of investing, there are three broad phases in investing. The first is the accumulation phase. Accumulation phase actually refers to the investment phase, where I'm investing with the idea that in the future I will be accumulating wealth, right? So that's the accumulation phase where I am investing and I keep on investing. And the idea is I will accumulate enough in the future. That's my first phase, which we start with whenever we start investing. Then there is a transition phase. Now, transition phase is a mixture of accumulation and maybe the third phase, which is the distribution phase, where I am continuing accumulating, but I also have certain milestones or goals for which I need money. And this becomes the phase where I am utilizing some of my accumulation, but at the same time continuing with my accumulation. So this is my second phase, right? So first is accumulation. The second is transition, where I'm accumulating as well as utilizing, because I have a milestone or a goal which I need to use my accumulated funds for. The third is distribution phase. This distribution phase predominantly works in the post-retirement, where now your regular income, in terms of, let's say, salary or whatever, whatever your regular source of income was, that's kind of stopped. And now you need to use your investments and the accumulation that you did all through these years to fund your regular expenses. That becomes the distribution phase. So we all in our life will go through these three phases of how we invest and use our money. The first is where you all start with the idea that we will accumulate certain wealth. Then there is a time when we are accumulating as well as utilizing some part of it. And the third is where now I have accumulated whatever I have accumulated. Now I need to use this money. So that's the distribution phase. So these are the three phases. And how do I invest? Of factors that influence my investing predominantly works on, there are four broad factors, generically, if I were to speak. One is what is my age? Now, why am I talking about age is because although again this is very generic, but it is said that people who are younger, have lesser responsibilities, can take a little higher degree of risk. People who are getting older subsequently reduce their degrees of risk. Again, like I said, this is not something which works for everyone individually, but a ballpark or a starting point, if you were to look at is age. To start with. The second is, basis market trends, the current state of the economy, how the markets are doing, somewhere, the various news, media, what people are talking about, the sentiments, they all sway my investment decisions. So if you look at, currently, markets have been at an all-time peak. This kind of, for some people it would be that, okay, this looks like a strong rally. I should invest more. People will start talking, and basis that, people start to invest a little more in terms of investing in the equity markets. You would look at far more people being very, very bullish and very, very confident of how equity markets are performing, and they allocating more funds. When the reverse of this happens, generally people then start looking at equity being a little more riskier, and maybe not their appetite automatically starts reducing for equity investments. So basis trends, also a lot of investment decisions get made. Then there is something known as disposable income. Now, this first two are a little more generic, but disposable income can also be very, very specific and very, very individualistic. What is my level of disposable income? How much of, post my expenses, what is left with me? And how much of that am I ready to invest? It varies from person to person, like I said, but it is an important factor. If I have a higher disposable income, my investment, will go high. If I have a lower disposable income, obviously I don't have that much to invest. And the fourth is responsibilities. what are your commitments, obligations? I mean, are you, I mean, how many dependents are you looking after? What are those things where you need to be available in terms of financially providing. All these responsibilities also matter. Again, it's very individual specific, primarily because if I have fewer responsibilities, I may be open to the idea of taking maybe a higher degree of investment risk. If I have a lot of responsibilities, I may not be very comfortable with the idea, right? So these four factors shape up my investment decision making, my investment choices. Where am I investing? What is the percentage of allocation in that investment? Uh, are predominantly, generally, based on these four factors. Let us now move on to understand the various life stages that we go through, and more importantly, not only knowing about these life stages, but being better prepared to not only manage the current life stage that you are in, but also for the life stage that you are going to enter next, and make investment decisions which will help you tide over those life stages comfortably. If I were to talk of life stages, there are predominantly four life stages. One is bachelorhood. Then the next life stage is when we get married. The third life stage is, when we become parents, we have children. And the last one is retirement. Each phase comes with its own responsibilities, complications, and these have a color in my mind, and rightfully so, with regards to what should my investments be. So let's start with the first phase, which is bachelorhood. Now, this is, the phase where you move from getting pocket money to earning your own money. It's a very big phase, as now you somewhere become economically independent. You earn and spend your own money. You start thinking that I am now responsible. I can take my own financial decisions. I don't need to ask maybe my parents for money, because now I'm earning enough. And what happens is, usually when you shift from pocket money to earning money, the first shift is a little extra exponential, right? So you get a far more jump over here to start with, right? And as expected, what we also do is we spend a little more, which is perfectly fine. I'm not saying anything right or wrong over here. Two things which we all should remember or keep in mind when we start with this phase is, we should ensure that all our expenses get comfortably covered with the income that we are earning. Because very easy with peer pressure and all of that, to spend a little extra. But then what happens is, you get into this risk of going into debt very early in your life, which in hindsight later on in your life you may realize that was not the best way to do it. So that's the first thing. So you should ensure that all your expenses are being managed by the income that you earn. And as you start earning, what you should also keep in mind is, I should also start making investments. As I've said in a lot of previous sessions, and I'm sure you read a lot about this also, whenever you researched of, when is the right time to invest, everyone says invest as early as possible. The right time is now. It's, and it is absolutely correct. So invest as you start earning becomes your best bet. And if you talk of investments, some suggested investments at this stage of your life, at the bachelorhood stage of your life, where your responsibilities are almost negligible or zilch, you don't have a lot of responsibilities, and hence, in all probabilities, your risk taking ability can be a little higher. So you could invest in those products which can perhaps you know are known to be a little more in terms of risk. So you invest in stocks directly or through mutual funds. You invest in equity funds. You invest in equity related mutual funds, and you even choose mid cap and small cap funds and invest a little higher degree over there. You perhaps even invest in real estate. If you think that's something which works for you, and it's something which suits your investment model, and you make these investments keeping in mind that today you are starting off your journey in investments. You have lesser types of responsibilities, so the probability of you using your money quicker is also lesser, and hence you can stay invested for a longer period of time. And in longer period of time, a lot of these suggestions that we are making tend to play out well. So that's where these become my suggested investment patterns, or suggested investments for people who are in this stage where they have just started working bachelorhood, or have spent a couple of years working, and they should start looking at investments from these buckets. The first phase, from bachelorhood, you move to the next phase, which is marriage. Now, this is your next phase. Now, over here, you no longer are just the carefree bachelor. You you become a little more responsible, because this phase would in all probability require some some changes in terms of what your savings and even investments are, right? As couples, your requirements and priorities will also change. You would probably not now start to think in you will probably now need to start to think about a house. If you not invested earlier in real estate, you would probably if you would want to now buy a car if you not already bought one, because now what happens is, in the, I mean in a bachelor day, you were on your own, so you were fine, and but as you move to the next phase, you have to make certain changes in terms of your requirement, in terms of what you require in your life. You would have some short-term requirements, you would have some long-term requirements, and hence your investments and the way you look at investments and the way you plan your investments would also need to change. It's only but natural, right? So in that sense, the suggested investment ideas that I would suggest is you could still carry on with some of the ones which you were investing in bachelorhood, but definitely, look at, ensuring that your SIPs, your SIP, systematic investment plans in equity related mutual funds are something which you seriously look at, and it's something which you must plan and execute diligently. At the same time, one more thing which you should all look at is ensure that you have adequate life and health cover, because now you are responsible. I mean, it could be now you would it could be that your income is also being used by your partner in whatever sharings you're doing. This becomes an important element in ensuring that if there are any emergencies or unfortunate incidences, there is a sufficient cover which helps in terms of not hitting you very badly in terms of a financial setback for your partner, right? So you must look at that. So this is your second phase. The first one was bachelorhood. The second phase is marriage, and after marriage, the third phase, like that I spoke about in the introductory slide, also is when you become parents. Now you have children, and now when the advent of a child, again the mindset changes in terms of investment and investment ideas and investment requirements. You start thinking about you should start thinking about what would be required for your child to lead a comfortable life in terms of their education. If a lot of people think about their marriage, a lot of people think about creating an adequate sum in terms of If my child wants to start some business, then there should be some seed capital which I'm able to provide. And in these things, the best way, if you haven't already shifted, now is definitely the time to move to a goal-based investment. Because now you have very, very clear goals, and these goals are very, very, so if I'm looking at, funding my child's, professional future education, and let's say I'm looking at 18 years of age for my child, and let's say my child is 3 years, 4 years, 10 years now, then I have that 15 years, 17 years, 8 years in which I'll have to fund it. Right? That timeline is fixed. So that goal becomes very, very important. If not before, if I had not thought about before, it becomes very, very important to start looking at that from a goal perspective, that I need to provide an X sum for my child to ensure if there is no lacking in terms of financial availability for him to pursue the course or the degree that he or she wants. So look at goal-based investments, definitely, if not before this, and if I talk of ideal or suggested investment, not ideal, but suggested investment products, then I would say that, you could continue with some of the earlier investments, but at the same time, you must look at, long-term investments, and equity-related mutual funds should be something which should become, your long-term investment vehicles. You should look at, some fixed income investments in terms of debt mutual fund products, in terms of, term deposits for your short-term requirements. You should also start looking at, the introduction of hybrid funds, if not already done, because they're a mixture of, if I were to just look at, hybrid funds as a broad category, predominantly they work into asset classes, which is equity and debt, and a mixture of this helps you in some kind of risk management, in some kind of asset allocation, and it gives you that cushion, and this cushion really helps you in building your portfolio, and keeping a level of volatility in check. So the third phase. So first one was bachelorhood. From bachelorhood, we move to the phase when we get married. Post-marriage, we move to a phase when we become parents. And some investment tweaking would need to be done in all of these three phases, predominantly because as my responsibilities increase, my requirements also change, and basis that requirements, it becomes very, very important that I'm able to provide comfortably, sufficiently for these requirements. The last stage is when I retire. Now, this is another big change. Right now, the first big change that happened to me was when was in my first stage, when I started working in my bachelorhood days, right? Because I moved from pocket money to earning my own money. Now, this is a stage where, that regular income which I'm getting in terms of salary, or whatever work I'm doing from where I choose to retire, somewhere stops. Now, when that stops, what this means is that then what happens is whatever my investments were, they would have to be used for my regular requirements. So hence, I need to ensure that I have adequate investments, savings to tide over this crucial phase. I also need to ensure that I'm able to earn consistent income from the investments that I had made during my earlier phases, and make sure that I am able to protect my investments from any excess volatility, and hence somewhere a level of de-risking in my portfolio also becomes important. And hence, what then needs to also be done is my portfolio would need to be changed. And somewhere for a lot of us, again, it's not a ballpark, it's not mandatory, but for a lot of us, it would become essential that I am able to somewhere, I need to, not able to, I need to somewhere reduce the element of risk in terms of my portfolio, because my own risk-taking ability with my money, because now I need to ensure that this money is available to me till whenever I have planned in terms of my survival, that this money is available for me. So in that sense, some suggested investment options that you could use, during this phase is, look at something which is government backed in terms of the senior citizen saving schemes. It gives you higher returns in comparison to your regular bank term deposits. And it is government backed, so the degree of safety is very high. You could look at ensuring that you have some money in liquid funds, which are part of the fixed income portfolio in the mutual fund scheme of things. Now they are known to give you returns in which are a little higher in comparison to your savings and current bank accounts. And hence, for your liquidity requirements, you could keep money there and you could use them. Use fixed income schemes, including term deposits. That's perfectly something which you should do. When you talk of equity, predominantly, a lot of people in this phase stick to the tried and tested large cap. They don't want to, move more into the mid cap and small cap phase, because there is an enhanced degree of volatility there. And this enhanced degree of volatility can, move their portfolio to a level where they may not be very comfortable. And hence, large caps is something which a lot of retirees prefer, and rightfully so, I would say. And you should also look, like I said in the previous phase also, hybrid funds is also a very, very good option, which you can continue using, because hybrid funds are a predominant mixture of equity and fixed income. So they help you, generate little extra returns in terms of the equity exposure. And the fixed income side helps you manage the volatility on the equity side. So these are some options, which we are suggesting. Like I said, it is not something which is something which you should use blindly. Investments is a very, very customized, personal, bespoke kind of a thing. Everyone's requirements, risk-taking abilities, idea about investments is a little different. But this could become a broad idea to start with of what you should be doing in every phase of your life. So, final word that I would like to share with you is, one thing which is for sure is, either knowingly or unknowingly, we all follow this life stage investing, right? So when responsibilities increase, you start becoming a little more conscious of what you should be doing. You start becoming a little more, detail oriented. You want to know a little more. You want to know that your investments are being managed properly. You get into a little more of that stuff. Primarily because you know you are responsible. You need to ensure that you hit it right. However, consciously following life stage investing will ensure that we do not have any shocks and are better prepared for the different life stages that we could pass. So knowingly or unknowingly, I'm doing, but if I become a little more conscious and plan for that better, I would not be ill-prepared or unprepared to manage that life phase. And hence that becomes very, very important, because although, let's say, the pattern of investing for a lot of us would be somewhere similar, our individual investment choices and options could vary depending on our own personal investment requirements, investment horizon, risk appetite, disposable income, funds available for investments. And basis this, I will make my investment choices. We should also remember that this process of wealth building or wealth creation is a never-ending process, and it is the most crucial in terms of successfully building a healthy corpus. And I need to start as early as today. This is what I had for all of us, and I would be more than happy to respond to your queries and questions. And like I said at the start of my session, please post them in the chat window and I would respond to each and every one of them now. Please put your questions in the chat. Okay, once again, I request all of you, if there are any queries or questions which come to your mind with regards to whatever we discussed today, whatever I spoke about, please feel free to raise them in the chat window and I'll respond to each and every one of them. So there's a question which is asking, which is not with regards to the topic, but will you conduct the seminar in Hindi language also, or slides in Hindi? So the thing is, we run this live for everyone across the country, and hence we are using English as our primary language. But if there is a specific request in terms of a regional thing, we could run it in Hindi too. So there's a question: when do you start withdrawing from the corpus through SWP? How long do you stay invested? Very interesting question. So systematic withdrawal plan is something which you should start predominantly when you require a regular flow of income. For a lot of us, this would be perhaps in our retirement phase, where I will withdraw regularly to fund my regular expenses. So that's when I should start. How long do you stay invested? You stay invested into something or the other at all times, because investments is what helps you generate some extra income, right? So that's how you should look at it. So there's a question: where do you invest in today's market for long term? I think for long term, we've seen enough data which suggests that equity related mutual fund schemes are still the best in terms of what they have done for investors. So I don't see any reason why we should stop and look otherwise. What is the best investment option for children's education? Again, it's something which is very, very personalized, customized. How long of an investment horizon do you have? How much of an investment are you ready to put? What is your requirement? And basis this would become a better, judge, rather than me telling you that these one or two options are the best. So don't go by that. I would suggest sit with some expert. Share your requirements in terms of what is your financial requirement. Share your how much can you invest in order to create that. And basis that, look at various schemes. What are the expected returns? What is your risk taking ability and appetite, and make investment choices. For a retired person, would you suggest equity-based hybrid funds? Again, it's personalized, but why not? I mean, a certain allocation in equity-based hybrid funds is definitely on the table for investors across life stages. For a retired person, would you suggest actively managed large cap funds or Nifty 50 index funds? It's choice. It's a personal choice. If you're comfortable with the index, you choose the index. If you think, active management will generate an extra alpha, please go ahead with that. Again, like I said, it's very, very personal. What your comfort level is Basis that, making investment choices, what your risk taking ability is, what your risk appetite is, for how long are you going to stay invested, would make you decide on what your investment choices should be. Anyone else? Any other queries or questions? Okay, great. So, thank you very much once again for your time and patience. I hope you enjoyed this session. And as usual, we will connect again in the coming months with another session, which will help you in making better informed investment decisions. Till then, thank you once again. See you. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.